Welcome to Alpha Insights. I'm Hope. Today we're digging into a small cap photonics story that's been through the ringer and now looks like it's trying to get back to business. With me is Kate, a fixed income specialist who also follows the optics supply chain. Kate, great to have you. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Hope. Happy to be here.
So Kate, start us off. Give the short version. This company had a wild 12 months. What's the headline now?
In short, the headline noise has largely faded, and the company is moving from demos and fundraising into actual shipments. The market spent months fixated on dilution, a short report, and a disappointing fourth quarter. But there are signs the business is finally executing.
Okay, walk me through the dilution piece. There were two $150 million raises, right? How did that land with the story?
Yeah. Management raised capital aggressively. Two $150 million raises over a few months, which expanded the share count by roughly 53% year over year. Long-term holders were understandably frustrated, but the company framed it as raising from a position of strength rather than scrambling to cover a shortfall. From a balance sheet perspective, the result is more than $300 million in cash on hand, which the company says is multi-year runway, not an immediate overhang.
Got it. So that covers the cash. Then there was a short report and a fourth quarter miss. Did that change the fundamental question for investors?
It did, because when you have a short report and a missed quarter, the narrative becomes credibility. Are they shipping real product, or is this mostly talk? The fourth quarter miss was stark. Revenue that many viewed as tiny relative to market expectations. The short report raised governance questions. But numbers can lie if you don't look at what matters for a hardware supplier: product qualification and supply chain access.
Interesting. So a working demo is better than a roadmap slide. What about manufacturing and customers? Do they have routes to scale?
They do seem to. Two large contract manufacturers, Foxconn and Lite-On, are not just logos on a press release. These are real supply chain pathways into hyperscale customers. Getting qualified into those programs takes months of engineering validation and audits. It tends to signal that a product can move from lab to volume, provided the company hits its production targets.
And production targets, what are they guiding to?
Management is targeting more than 30,000 unit shipments in 2026, with high-volume production slated to begin in the second quarter. If they hit meaningful volumes, that changes how you interpret a tiny revenue number from the reported quarter. The fourth quarter then looks like a historical artifact rather than the future.
Right.
Yeah, that's a good point.
Let's zoom out to the sector. Photonics and optical interconnects have suddenly become hot. What's driving that shift?
Two big forces. One, the AI infrastructure build is pushing data center bandwidth and power needs to new levels. Copper cabling and passive electrical interconnects hit a practical limit. People call it the copper wall, where reach and power make copper impractical beyond very short distances. 2. Investors and sell-side analysts have re-rated the space, moving optics from a niche engineering topic to a mainstream investment theme. Passive index additions and big order announcements for peers have created momentum. For context, companies across the stack are seeing big moves. Some assemble transceivers, others sell laser components, and a few focus on materials. The common thread is demand for more bandwidth with lower power consumption. That macro headwind for copper is tailwind for optics.
How is this company different from the others in the optics space?
POET's architectural bet is the optical interposer. Instead of assembling lots of discrete optical components and aligning them mechanically, an optical interposer integrates lasers, modulators, and electronics on a chip-scale platform. That can reduce packaging complexity, lower power, and make co-packaging with switch ASICs easier. It's a different approach, less about incremental component improvement and more about changing how the parts are put together.
That sounds like a longer timeline, though. Is there still execution risk?
Definitely. The roadmap is longer, and the technology risk is non-trivial. But the signs that matter now are product demos, supply chain partners, and unit guidance. If they actually start shipping high volumes next quarter, a lot of the maybe questions turn into measurable outcomes. That said, small cap valuation and an expanded share float mean volatility will remain high. There will be drawdowns on macro shocks, profit-taking after peer rallies, and any quarter that misses the most optimistic scenarios.
Investors should expect bumps.
Exactly. Analysts note that a larger cash runway reduces near-term dilution risk, but it doesn't erase execution risk. We should also remember that market sentiment has swung. The sector backdrop has rotated from skeptical to supportive, which helps, but momentum can reverse quickly.
So what's the near-term calendar that matters?
The next big milestone is May 12th, when the company starts the chapter where shipments are supposed to ramp. After that, each quarter of actual unit shipment numbers becomes the most important data point, more than press releases or debate about past raises.
Wow, okay.
Honestly, I was a bit surprised by how quickly optics moved from niche to mainstream. But the technical drivers are real, and that's why the whole group has gotten repriced.
The market does love a theme.
It does.
Before we wrap, a quick reminder about perspective and risks.
Sure, this is informational only. Analysts note that while the bull case has widened, the stock remains a small cap name with a high revenue multiple and continued execution risk. Watch actual unit shipments and customer qualifications rather than headlines. And watch macro volatility. Energy or rate shocks can still compress multiples quickly.
Great. Let's close with 3 quick takeaways.
1. The company moved from demos to demonstrated hardware and has supply chain routes into hyperscale customers. 2. Management guides to more than 30,000 unit shipments in 2026, with high-volume production starting in the second quarter. That shifts the story from promise to execution. 3. Sector momentum helps, but the enlarged float and small cap status mean volatility will be high. Outcomes hinge on actual unit delivery.
Perfect. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for joining, Kate.
Thanks, Hope. Great to be here.